Well, good morning, everyone. This is Glenn Thompson, and we're about ready to start. For those of you who heard me a few minutes, just 2 or 3 minutes ago, I mentioned that we're a little late. One of my coworkers, Ken Chow, is completing his presentation, so wanted to give him as much time to complete as possible. I think we have the audio. Can you see the screen, folks? Do we have the visual as well? If someone can just indicate that on the right side of your screen, I appreciate it. Thank you, Gio, and we are ready to begin. So welcome everyone who's there. I just hit the recording button, so you're able to access a recording of today's program if you want to review or if you come in late or miss any portion of it. As you see on the screen, I'm Glenn Thompson. I work as a mentor at Pacific Trading Academy. If you need to contact us concerning any of our programs or what I do in particular, or anything involved with us, you've got the contact information here. Pacific Trading Academy, 800-339-8588 is the toll-free number. You can also take a look at our website, www.pacifictradingacademy.com. Normally the person who handles all of my marketing and business arrangements and is able to give you more information concerning what I do in teaching and so forth is Peter Newman. He is out of town at the moment, but either Peter would, in spite of him being not near the home office, may contact you, or Frank Cameron may be handling his responsibilities, at least in part, until he returns, hopefully next week. But in any case, any questions would be directed to either Peter Newman and or Frank Cameron. Well, great. Again, welcome, folks. If you have questions during the program, if they're pretty straightforward and I can address them without interrupting the flow of today's presentation, great. If not, I think we'll have time. I always say that, but hopefully we'll have time at the end. I didn't see any scheduled programs after mine, so we have a little flexibility and leeway on the back end. All right, oil and OPEC, preview of oil and OPEC. I am also curiously scheduled to be a speaker this Monday on a panel discussion, and we typically have questions, the general nature of which is what events during the week, this coming week, do we think will play a pivotal event in determining and informing markets. And certainly at the end of the week, June 5th, this coming Friday, a week from yesterday, OPEC meets in Vienna, and I think that will be a critical fundamental event or event on the fundamental horizon, if you will, that the markets, especially oil and specifically, will be responsive to. So that's why I chose the topic. I thought it was appropriate. Curiously enough, as you'll see in one of the slides towards the end of the presentation, I projected some time ago a time target for June 1st, which is this Monday. So more or less, when I learned that when I realized that OPEC was having a meeting this coming Friday, June 5th, putting that together in my head with my projected time point for June 1st, I'm saying, given an allowable amount of error, more or less the same events. I don't think it's coincidence that they're 4 days apart. So assuming that OPEC is a definitive event on the fundamental front, again, probably it's more, I would expect to see some volatility and possibly some important motion in the energy sector this week in light of those two events being pretty proximal and coincident. Let's move on. Some of the information, I guess I spoke about oil a month or I think it was at the end of April. Yeah. And so a lot of what I talk about today will represent the most recent information I'm aware of and my thoughts and forecast and how to exploit it. We actually got short oil 2 or 3 days ago, meaning in my own accounts and the traders that I work with and that choose to take the signals that I generate. So in light of the move that happened yesterday, a little move up, I'm in drawdown currently. I'm a little behind. However, some of the people that I advised, we got in options, so we bought time. So plenty of time. I am bearish the market. So again, we took the short position in light of my current overall viewpoint and projection. So let's proceed, and I'll kind of give you some points that constitute the argument for my particular view. Those of you who've attended seminars and webinars in the past or heard me know that I place a lot of importance in my analysis on timing. Should always take precedence over price. My explanation to that would be, even though I'm a technician and the central theme of technical analysis is that price discounts all information, that which is known and even the information we don't know, I always say, based on the factors that are responsible for what price does and the price returns we see, I believe is the primary causative factor or vector or agent, certain specific elapsed amounts of time correlate with the particular price changes we see in a market. But timing is critical to me, and that's why it helps me formulate my view, as you'll see. All right, this is a slide. Actually, I thought about this morning. This count is kind of inverted. If you look back, well, the 3 should be kind of a bottom, because we have been coming down for more than a year. Specifically, the top that came in at the end of last June, first week of July, depending on which particular energy contract you're looking at. This is a June contract in oil, so 3 should be down here. This is the 4th wave, I think, of a move down. And by the way, folks, those of you who are not familiar with Elliott wave, these numbers are just Elliott count designations to indicate a descriptive within the context of an Elliott model description where I think and why I think the market's doing what it's doing and where it is likely to go and what has accounted for its motion through the present. So let me take this off so you can see. Yeah, I think this is the top back almost a year ago at the end of June last 2014. So number 3, even though it should be a bottom based on our wave count, it was an important top that came in a year ago. Basically, it'll be a year at the end of next month. And I think I'm sorry. This is the top. This is the top last summer. Number 4. This is actually going back a few years to 2011. And all of this action here, you can see it's a well-defined. I stuck with the June contract. This was, again, from a program I'd given at the end of April. The reason the subsequent slides will indicate the July contract, July of 2015. I wanted to use this older slide because it has a fairly well-formed triangular construction, which is typical of 4th wave corrections. You can see the A, B, C, D, E, and then up to the 4th wave. And then if that's the end of the correction 4th wave, all of which everything from 2011, a multi-year of correction, which is typical again of 4th waves, ending at the top that came in at the top of the high prices a year ago, last summer, and everything since the high prices that the varying contracts achieved last summer through where we are at the close of yesterday, I believe is an impulsive 5th wave, a bear market 5th wave, and that's what accounted for the decline that we saw, pretty much the major portion of which ran through this year, since the beginning of this year. But even it actually started the tops or the high prices last. It'll be a year at the end of this next month, June, and this is the internal count. If everything from the high, let's say the June 27, 28, or if certain contracts maybe the first week of July of last summer, if those highs that came in a year ago mark the end of a correction wave 4, ostensibly they mark and coincide with the beginning of a 5th wave coming down. And I think the 5th wave may have been in with the bottom at the end of last year, December, or the first quarter of this year. So there's some area for questioning there in terms of the specifics of the description, but more or less everything from last summer's highs through where we are yesterday, I think, is a 5th wave. The numbers we see here from to the right of number 4 are the internal 5 waves or portions of that that you should see or expect to see forming within that larger degree 5th wave. So you have the 1, the 2, I believe the 3 comes here. I ended 3 here because it's the Fibonacci degree of proportionality. This might be the 4, and then everything down to the lowest price we saw oil trade to is the fifth of a fifth, possibly. That's one description. So this is a slide again that I presented a few months ago. All right, and this is the current wave count. This is still the June. I'm not sure why. Yeah, that's the June. I don't know why I didn't switch to the July, but it's more or less the same. All of this is correction. Everything from number 3 over here to the top again last summer. This number 4 represents the high price that was achieved a year ago, at the end of June last 2014, and then the major decline, the precipitous decline, I believe, was either a complete fifth wave or a portion of that fifth wave. All right. And that brings us to the lows that we see in price, and then we've had in the last few months a rally off of that, I believe. Folks, let me just check in. Are you still good on the audio and the visual? Are we here? I want to just double check, make sure there's no technical issues. Great. All right. If you have any questions while we go, write them. Fine. Thank you. Maybe Frank. All right. If you have questions, you're able to write them in the same area, and then I can, at least in a cursory sense, address them now, and then we can get into more comprehensive response at the end of the program. One of the points I should make is I don't intend for today's webinar to go into the detail on any particular model, say, for example, the Elliott model. I'm just, for those of you who are familiar with it, you know what I'm talking about. For those of you who aren't, under other circumstances, I'm happy to go into this, but I more or less want to present a big picture view of what I expect oil to do today, and point out some opportunities for profit. All right, so this is just a little more detail. This is showing the June contract, and so everything from last summer's top to where we are right now, I believe, is a fifth wave, and then at least down to this bottom here. If not more. We may still be in a fifth wave. There's some other plausible descriptions or wave counts that would suggest the possibility we are still in a fifth wave, all of which, the ramifications of which, are bearish. If we think that the fifth wave has ended with this bottom, the lowest point on the screen here, then there are some plausible bullish scenarios as well. So I want to explore all sides of this oil coin, or energetic coin, if you will. And we're going to look to reconcile some fundamental situations, the supply and demand picture, along with the technical. So let's proceed. This is just this. Okay, so this is the July count, or July, the wave count applied to the July contract. So if this is the top back last summer at the end of June, first part of July of 2014, and so the rally we've seen, that's either the bullish determination or a bullish wave count might suggest that if in fact the lowest point on our screen is the end of a fifth wave, well, what happens theoretically at the end of a fifth? You have an outright reversal due to one of two factors based on the Elliott principle. Either the market will forfeit and skip the correction and just generate it. You have a sea change. You have a flip-flop or a transitioning from a generic bear to a new generic bull market, or you have an ABC correction. In either scenario, you can expect an outright trend reversal once a particular fifth wave has completed its formation. So assuming this lowest point on the screen that the price achieved here, down in the $40 range area, all of that could be the start of a new bull market, a wave one. And then the pullback we've seen since the top from the middle of this month might be a correction wave two, which may have ended with Thursday's bottom, or maybe more to go. We'll see. That's unknown yet. Let's assume that Thursday's bottom, when we kind of had a sort of a key reversal type structure on this past Thursday, let's assume it marks the end of a wave two in this bullish scenario, then it would suggest it's also the start of a third wave, and that would be quite bullish. That would bring us up to the 82 based on Fibonacci relationships. So there is that possible scenario, and it could be. I don't think that that is the case because it's inconsistent with other factors, namely the fundamental picture that describes the market, and especially what I expect out of Saudi Arabia come next week. But I can't rule it out. completely. If in fact this marks the end of the long-term bear market, and then the move up could be to fit it into a framework contextualized by the Elliott model, could be a first wave. This recent pullback from the tops, the top price that came in middle of this month, could be a correction to that. And then once that's complete, we could see a major thrust higher. And so who knows, maybe OPEC will surprise us. I don't think that's happening. I would place about 85% confidence that the news out of OPEC, primarily governed and dictated by the views and prevailing thought of the Saudis, I think will rule the day, but you never know. So we have to allow for a spectrum of possible scenarios, and try and see where we see the greatest degrees of alignments to establish our alliances of viewpoint. All right, but that is a potential view, a bullish wave count, assuming that's the end of the fifth wave of the bear market. Everything we've seen could mark the origin and the seminal stages of a new bull market. That's not my favorite count, but I wanted to be aware of it. Moving on, this is an alternate wave count, which could kind of 50-50. It could go either way. If again, the same bottom, the July contract in crude oil, the traded here in the U.S., the alternative is that all of that move off the bottom in March up to the recent top in the middle of this month could be an A wave of what would ultimately form as a larger ABC three-wave correction. If that's the case, the pullback that we've seen since the middle of this month of May, it could be a B wave of what will ultimately form as that larger ABC. All right, so either that's complete. Notice that on Thursday, the key reversal type structure was forming in and around a 38.2 Fibonacci area. I don't know that that's going. I doubt it's coincidence. Notice you got that consolidation. We had a little support there in the past, so the market respected that 38 fib level. Basically, is what the point I want to make. And then we moved up yesterday. I had a big move up yesterday. We settled yesterday in the July basis the July contract at just over $60, 60 and 30 cents per barrel. So big move up yesterday. I actually kind of, from my positioning, talking my book for a moment, I actually like that because my next time point, again, remember, is this coming Monday. So the way I react to a time point is, initially at least, to expect a reversal as the market arrives at that particular time point. So we'll have to wait and see, but that's at least my initial rumination and possible projection as to what I can expect will happen. And that would still be consistent with a bearish view overall. So if this is, if we're, on the other hand, if that was just a one-day phenomenon and we're going to come back down into the first part of next week, that would suggest that the B wave of this correction is not complete and there are further declines or offering lower, possibly to move on down to the 50 or 62% fib level. We'll see. But again, the last two sessions, yesterday's session and Thursday's session, did look very price constructive in terms of the key reversal type structure. The close of Thursday being higher than the previous day's close is the component I'm specifying when I indicate its key reversal type. And the fact that it occurred in and around that 38.2 Fibonacci level, I don't think is coincidence. And then the fact that on the heels of Thursday's action, we had a big move up to settle over $60 yesterday is price constructive. And that could mean that the B wave is in which case we're going to move up immediately into a C wave. And that would be, if we see next week, for example, the price move up possibly into the end of the week, congruent with the Friday's meeting of OPEC, that would still fit into a potentially, well, it would mean that all next week, for that window of time, we would expect rising price possibly. And then that would still, and then it would remain in where we would go from into the following weeks as we move into the summer would remain to be seen. If it's just an ABC correction, I would expect the news out of Vienna would be bearish. I would not expect any indications of cuts in production, but rather a maintenance of the current supply or output, or even a furtherance of that, along with other nations and other factors. Another issue unrelated directly to OPEC, I mean, it's all directly to OPEC, impinges and has to do with OPEC, but the specter of Iranian oil coming back on the market is another fundamental factor that I want to be aware of or cognizant of. That's considerable additional barrels of oil, assuming that the U.S. and its allies achieve some degree of reconciliation and sanctions are removed off of production concerning production of Iranian oil. That's going to ramp up supply levels, world supply levels of oil, and that would, all things being considered, be a bearish component. That remains to be seen. I just didn't, I want to make it explicit. So this is could go either way. This is the bear bull count. If even if we see this in the shorter term for the next week or so, congruent with the OPEC meeting at the end of this coming week, next week, a price rise into that, to some extent, the market discounting the possibility that the policy out of Riyadh will remain consistent with what it's been, the current, and all indications seem to be thus far that will be the case. Again, I place about an 85 or high, let's be conservative, 85% probability. I don't expect any type of cut to be announced at the end of the week. All right, so that would have longer term bearish ramifications, even if in the shorter term, over the next week or so, we see a rise into the meeting and congruent with that meeting. But ultimately, that would mark the end of a correction. And longer term, what happens after that? That would complete an 8-wave cycle, 1, 2, 3, 4, 5 ABC. What happens theoretically based on that conclusion there? You start a new cycle, always in the same direction as the preceding cycle. So that would certainly be quite bearish for oil prices. So this could go either way. We'll see. Either yesterday's action was a blip and an outlier, and I would expect a resumption for a lower B wave to form, or even if it's or if not, if we move higher, that would be the bullish version, and it could either be just in order to form or complete the formation of a C wave of a larger ABC correction. So this is a count that could go either way, depending on whether or not that B wave is finished with Thursday's low, or if there's more of the B wave, or if it has completed and we're going to move on to the C. All right. Next slide. Bear rally. Oh, this is just a slide I presented a couple of months ago to indicate that the low that came in at the end of last year, I was thinking at that time everything was just a rally in a bear market. Even as far back as the first part of December of 2014, I was expecting that the price appreciation at that time should be interpreted as a rally within a broader generic bear market. So just to give you context, and here's my current scenario. This is the count that I favor or attach the greatest importance to currently. I think this could be the 5, and then everything we've seen since that bottom that came in in the first quarter of this year, say at the end of January, first week of February, this bottom right here marks the end of a 5th wave, and then an A, a B, and then possibly the top that came in the middle of this month is a correction C. If that's the case, the reason we've fallen is a new bear market wave 1. A new cycle has begun with the top that came in a few weeks ago. All right, so there is that possible wave count, and that is inherently and immediately, sooner rather than later, bearish. That would have very bearish implications sooner rather than later, consistent with the meeting coming up this coming week, at the end of the week. So, if you can see that down here, folks, that is a wave 1. Who's to say how low it could go? First waves are, being the seminal wave, again, are notoriously challenging to forecast in advance. But again, let's see. The top came in here. That's about May. I'm trying to remember the date on that. I have it in a future a slide that's coming up. I just can't recall when that top came in. I was looking. Anyway, it was a few weeks ago we had that top, and then that could mark the end of a previous bear cycle and the onset again of a new bear market cycle. And wave 1 would potentially be somewhere down here. All right. Let's move on. This is just an overview, I presented this a couple of months ago in the presentation, just a slide indicating just a quick accounting of some of the fundamental reasons why I'm bearish. Supply demand, slow economic growth worldwide. In China, the European Union, and Asia is represented by Japan. You've actually got negative growth. Lower global demand, rising production, even in the U.S. with the rig count being cut. A lot of the rigs that were taken offline were underperforming rigs in the first place. So U.S. production has been projected to increase as well, even though we have declined or decreased the rig count here in the U.S. in terms of shale production and fracking and horizontal drilling and all the varying types of extraction that are possible. OPEC forecast demand for 2015, 29 just over 29 barrels per day. And the forecast for going out to 2017, 28, our current production or output of OPEC over 30 million barrels per day. So that's a surplus, as you see, over 1.5 million barrels per day of surplus. The IEA forecasts global demand down 230 barrels per day to 93 million barrels a day surplus, of not quite as large a surplus, but nevertheless in absolute terms a surplus. So from a supply demand, and these are not details, I just wanted to present a bigger picture idea of the supply demand scenario. We have been over the last few months continuing to get economic data that suggests we're getting mixed data here in the U.S. in particular, and that's been mirrored and reflected worldwide as well in terms of tepid growth. I think GDP came out yesterday, and so the numbers, and there's some debate about the accounting, whether or not it took into account seasonality in terms of GDP and the weather and all these things. But bottom line, the Fed, our central bank, has determined that we're not seeing a revving up of the economic engine, as it were, sufficient to warrant a raise in interest rates. And I think the U.S. dollar, in the final slide, oil's priced in dollars and has been for years, and I think the dollar has interpreted that positively. Yes, there is a knee-jerk inverse relationship between the cost of money and the intrinsic value of money, that is interest rates and the nominal value of the U.S. dollar, or any currency for that matter. What overshadows or supersedes that in importance is the dollar's take and interpretation on what's good. I always tell people, if a country issued stock, its currency would be its equity, its stock. And so basically, as a country goes, so too does its currency. So to the extent the U.S. dollar perceives moves by Janet Yellen and the Fed to be positive and supportive of our economy longer term, I think that will strengthen the dollar. The weakness we've seen of late in the last few months in the dollar, I think, has also helped the U.S. in terms of the export picture. By the way, folks, let me just take a time out here. I'm talking and bringing up some points that are fundamental. Rarely do I do that. I'm not a fundamentalist. I am a technician. When it comes to oil, I remember reading when it comes to oil, because it's so politically and strategically expedient, the argument could be, I don't think it's a hard argument to make, that oil is the most important, at least important commodity, at least from a strategic standpoint. The entire planet revolves on nothing but oil primarily, first and foremost, to this day, and I think will remain, that relationship will be in place for some time to come, even as we are searching for alternative fuel sources. Oil runs, shapes a lot of our policy and on all fronts, militarily, politically, domestically, internationally, etc. The world runs on oil, and as such, it would be incomplete for me to present a thesis of view solely on technical underpinnings. I do most of my trading and investing in decisions I make where I put my money on the line. Ultimately, at the end of the day, certainly I must have technical support, and that's how I start. But when it comes to the energy market and oil in particular, certainly I want to have at least a peripheral awareness of what's going on and look to see where I see nexus points between fundamental scenarios and what the charts are suggesting. All right, this is an important slide. What is the threshold or chicken price? In other words, where are your margin levels relative to the price of oil? An energy research group, Wood Mackenzie, did a survey of over 2,200 oil fields throughout the world, and only 36 of them would have a negative cash flow if the price of oil, when the price is down below or at 40. The marginal cost for U.S. shale producers is about 10 to 20, so you can see that, barrels per day. And that's the same for the oil producers in the Mideast, in the Gulf producers. So the point of this slide is certainly we can a lot of the majority of producers can maintain operations with much lower prices. Saudis have tremendous, I think I forgot the figure right now, but the currency reserves are sufficient for them to continue having a focus on capturing and maintaining market share to the exclusion of revenues, and they can do so for at least another 2 years based on the numbers I've seen. And so that suggests that they are perfectly fine, or they don't have any external or internal particular incentive to deviate from their current policy of maintaining at least current production just over 30 million barrels of oil per day for OPEC's entire output, or even increasing it much, rather than cutting production. So again, I want to constantly harp on that. I think that is the key factor mediating and to which energy prices at large will be sensitive to in the months ahead, immediate months coming up. All right, let's see here. Let me switch. Next slide. This is a slide that I presented. Let me just take a time out, folks. Any questions here at this point? All right, no questions. All right. This is, let me just double check. All right, everything's fine. Good. This is a slide I presented in the presentation on oil back in April, I guess, where, again, relative to my the first slide where I said everything is a function of time in terms of price returns, and this specifically shows an overview of this. This is actually going back. It doesn't matter the structural geometry of whether it's the May, the June, the July, the August, the September as we move out. The price structure is the same, and the spatial relationships in the price and what the market's doing are more or less the same. The prices themselves are different because of the premium, the cost of carry in varying months and so forth. But overall, the structure of the market and what it's doing is responding in the same way regardless of the contract. So, and it's time invariant, doesn't matter. So these are past time points that I projected for oil, and you can see, for just by way of review and also to get context relative to the slide that the subsequent slide coming up. But these are the points where I projected in prior to them occurring, the market would change, or to simplify that, have a greater than average probability for a trend reversal, say a top or a bottom. A little simplification there, but more or less that's what it says. So August 4th, September 16, this is back last year, October 4, November 11, December 17. That was very close right there. Basically, the little triangular fourth wave onset there. December 17, the last of last year. February 3, right in here. February 23. Now, okay, at the time I guess I did this was back in the first quarter, and we had not yet come. So these were my theoretical projections. You can see, I guess at the time when I first presented this slide, February 23 and March 17. These are some time points that I had projected. That was then. This is now, bringing us to the future. This is just some of the ones that we had projected. February 23. Notice it came in a day or two, or it's actually, yeah, it came in very close to that bottom. Whether or not that was a tradable event is a secondary, albeit important idea, but more or less for analytical purposes, I want you to see the history and the degree to which these projections were or were not reliable. They are at large very reliable, I think. Um, okay, so it's testament to some of the ideas and tools and relationships that enable me to do this. Okay, so February 23rd is the time projection. March 17 came in very, you can see, here's the bottom. I actually don't recall if that was the bottom, or I can't recall, but I might have purposely put this a day ahead just to show you that the bottom, I think that actually pegged the bottom perfectly. If not, it was one day before. 317. April 23, I think, caught that bottom. I put it one day after so you could see that the bottom came in right there. By the way, you can see that little wave structure here. 1, 2, 3, 4, 5. In that move up. If this is the end of the fifth wave, the bottom on 317, and then this move up here would be either an A wave or a wave one of a new bull market. If it's an A, it's a bear, still the bear market cycle, and this would be the A. We'd be moving down possibly this Thursday's low 2 days ago could be the B, or the B is that not this. This is printed out at yesterday's close. It's possible that that's just a one-day aberration, and we could come back down, still forming the B wave of a larger ABC correction, and then go back up again. Or we're already set to go back up. But you can see what the price action is not the main point of this slide. I want you to see the flow of the time projections and the market's response to such. So we had a time point May 22nd. That was here. I didn't call this top here. There's some turning points that ultimately the market proves are pivotal, but failed to show up on my particular theoretical radar screen, as it were. That you can't get everything unless you can. But in any case, May 22nd was a minor top within the move down. And the next one that I alluded to is June 1st, which is this Monday coming up. So you can see it is I like what I'm seeing. It's possible that we'll move up into the close of Monday if I'm perfectly reliable and precise. Or again, it might move up into the meeting on Friday. So in which case I had the right idea. It was just off by 4 days. Not bad. Again, it might be bad if you're, depending on the window of time or your time horizon. If you're a short-term trader, then it could be very significant. But in the bigger picture, just theoretically trying to piece this together and mix and reconcile probable types of market behavior with the specific windows within which we expect those market moves to ensue. And then I've already projected out the next projected time point is middle of July 14. So whatever we do, assuming the market is responsive to what happens, say, on or around June 1st. And so I would broaden, in light of the fact that the OPEC is meeting Friday, June 5th, I would broaden this time point to include a window, not a point of time, but rather 6/1 through June 1st to June 5. Could be a window within which I expect trend reversal to ensue. Let's assume that occurs, and let's assume that the market arrives at or to this window moving upward. I would expect it would more likely correspond to a market top, and then overall, all other variables being fixed to isolate this relationship of market action vis-a-vis allotted time for it to move. I would expect the trend to be down into the middle of July. And so that gives us a sense as to the possible runtime, acquiring a sense of possible runtime for a given move. It allows me to at least make some beginning conjectures as to the probable distances. What's the magnitude of a move I might expect given a certain allotted time available for the market overall to move more or less in a similar direction or the same direction. So that is assuming that ultimate grand scenario were to manifest and pan out, that confirms my bearish view or not. It's possible that the market, even if it is sensitive and responds to the time window of this week that I anticipate is very highly, I would give this about a 90% reliability expectation. 90% confidence that the market will change. Let's say it changes in a continuation way, it just accelerates to the upside, then certainly that I would expect the market to move up into the middle of July, and that would certainly be a very bullish view. It's just that on balance, all of the varying bits and pieces of different information that we acquire from different sectors of the economy, be it quantitative, fundamental, technical, etc., don't support that bullish view to the same degree that they support the alternative idea of lower prices. But in any case, this is just the pure time map, if you will, and then I kind of evaluate the price changes in that context. All right. This is an older, let's see here, this is the COT report from a few months ago, showing as the price was rising here off of this bottom, the commercial activity, this red line here, this is the commercials, were increasing their net short position. So you can see and so that's inherently bearish, even though the green line is the institutional money, big specs, large speculators. Volume is rising, price supported. That's certainly bullish. Open interest is kind of, the purple line or lavender line was kind of flat, meaning in the net, no new change. The turnover of positioning is more or less constant. It's not, there are not new longs being added or not new traders coming into the market. More or less the activity of new development or is more or less the same, whereas the bars are volume. The volume is overall going up while the price went up. So that was price supportive. Now this was again through the end of April, I guess. And so let's fast forward to the present. I printed out another report yesterday showing the commitment of traders activity. And you can see through, this is through yesterday, I guess yesterday or the day before's activity, the commercial net positioning has increased. It has increased its degree of net short. So it is at the lowest level going back for the last 6 months. That is inherently bearish by itself. It's curious because while this is happening, the price has been coming down. The volume has been going up. So that's volume is going up while the price is coming down. That's bearish. An increase in the net short position on the commercial front, that's also bearish, so 2 points to the bears. However, notice that open interest, if you can see that purple line here, is decreasing. That's saying that the reason the market's been coming down, so from that important top a couple of weeks ago, is not new sellers coming into the market, but rather old longs. That's long liquidation. So that's not, and so that's certainly consistent with the action we saw yesterday. That's not depicted on this chart. I guess I printed this out Thursday because we had a big move up. So what would have been more bearish is if while the price, from when it hit this top here, if the open interest line had been rising, indicating that it's new sellers coming in, but the fact that it's slightly declining is an indication as to why the market's declining. That would be as a consequence of longs exiting their longs. Why is that? Obviously, look at you can see they were long here, they were making money, and then with the decline, it's cutting in and it's eroding to some extent, if not all, their profits. So they're running for cover in order to capture, and that falling out, that selling pressure is what bid the price down since the top was achieved there. Nevertheless, this is, I think, in balance, more of a bearish report. What it would have been even more bearish if the blue line here, the small traders, were extremely long, because they tend to be wrong about 80 to 90% of the time. But again, the central, first and foremost, is that we realize feature you want to take away from this slide is that commercials are at their largest net short position for the last well, this is 6 months of activity. It actually is longer, going out closer to a year, but the chart only shows you through the from the beginning of this year. All right, so that's this commitment. That's the commitment of traders, the government's report. This is just the recent APR report from this week. I won't spend too much time on this slide. API data shows U.S. crude supplies up 1.3 million barrels. Again, just showing you an indication of recent. This is as of weekend May 22nd. Rising supplies. July crude was at, okay, it's $57, etc. So again, further or additional just reiteration of the supply picture. Rising U.S. production. This is just in the U.S. While again, put that in the backdrop of tepid global U.S. demand and worldwide demand. So that spells again in a broad macro sense a likelihood for lower prices. I am oversimplifying because I'm not taking into account exports, imports, and so forth. And all of these, the data that I'm indicating, there's a stationarity to it, meaning that conditions change. Obviously, all factors in our world are in flux. But we try and extrapolate based on some expectation of the inertia of these phenomena, what is likely to occur, and go from there. So that's just the API report. This is a sentiment indicator. Extreme degrees of sentiment, especially for oil. When you have great fear, that's a buy signal. So it's this green line here. If you can see that has hit a bottom. That was very bullish, and that corresponded with the bottom that came in at the beginning of this year, and we've seen prices rise accordingly. You see, when you have great optimism, the opposite, when this green line is at a top, or bullishness, that's an indication for a market top, which we don't have. So this is by itself, the fact that it's moving up off of, it's still bullish right now, the sentiment indicator, but it's not as bullish as it was when that green line here hit that bottom at the beginning of the year. But so we can see the degree of bullishness in the price is lessening as a consequence of this sentiment extreme reading. And this is a very reliable indication. All right. Saudi Arabia is a solution to the global oil glut problem. Certainly, their response is produce more oil, but use it as we move into, or pump it out of the ground, and pump it for all of the things that domestically are required. And certainly as we move into the summer months, especially on the products, we have rising expectations. Driving season after Memorial Day, we have a seasonal component, and especially in unleaded, where we expect it. But insofar as, in particular within Saudi Arabia, this is their response. This came out about a month ago. Increasing production and exports is a clear implication of Saudi's new oil policy. So increasing production. So if anything, the catchphrase here, and what I'm expecting at the end of the week, is rising production. If any change is made, I don't. To the extent there's a change, it would more likely would be an increase, not a decrease in production. The biggest member of OPEC boosted output 10.1 million barrels a day in March, and let's see, the oil minister Ali Al-Naimi, who has stressed that his country will not cede market share to higher cost producers, said at the capital in Riyadh that production was 10.3 million barrels and would remain close to that. So if anything, again, I expect a continuance of energy policy. If there is a change, it more likely would be a rise in production, not a cut out of OPEC. The outlook for demand suggests the Saudis will keep production at elevated levels. The outlook for demand suggests Saudis will keep production at elevated levels. So this is these are just an overview of various analyst views and expectations for what OPEC's going to do. I won't bore you with all of that. All right, this is just something I printed out yesterday specific to U.S. production. So U.S. oil production surged to a 43-year high despite a price war that knocked off 50% of price and 50% of reduction in oil wells. Excuse me. Oil prices saw downward pressure in a volatile trade. All right. Let's see. Department of Energy reported the U.S. production rose 9 to 9.566 million barrels per day, surpassing the previous peak. From a supply and demand standpoint, record production in the United States and production in 10.3 million barrels a day from Saudi Arabia to confirm that the global supplies are ramping up in the face of lower prices, not falling. So that's interesting. Okay. Let's see what else. If there's anything else I want you to glean from this. This is just an indication of the prevailing views of what is to be expected to, be a major factor that will come out of Vienna on the end of the week. With U.S. rigs are now down more than 50% from last year. Traders and analysts have speculated that the rigs coming offline are those that were already declining. I think I mentioned that earlier today. In addition, many investors believe lower prices would squeeze U.S. shale producers to produce less. but the data are showing otherwise. We're producing more. That's a critical point. Lower rig count here domestically, but still production levels are rising. So on all fronts, international and domestic, we're seeing an increase in production. Now, I don't want to be. That might suggest a case or a scenario that's too bearish. We are seeing supplies or drawdowns in barrels in supply levels. So it's possible that with Memorial Day and the start of summer driving season, demand picked up, and that's seasonal, especially with gasoline, not necessarily in crude, but we are seeing crude drawdowns as well in stock levels as well. So now that's domestically in the United States. I don't have the figures in terms of worldwide, but we are seeing drawdowns in stocks, in crude stocks domestically, in spite of rising production. That is not the case. I just don't know the specific numbers off the top of my head. I should have included that. But I do know qualitatively that stock levels worldwide are constant to slightly increasing, while production overall worldwide and domestically is in both cases is increasing. Okay, the Saudi Arabian vote is the one that counts in terms of the meeting. So yeah, they're the flagship nation, and ultimately will carry sway. The rest of the world will basically, for now, go along with whatever their policy is. The Saudi delegation will be scrutinized. Iran, typically the loudest hawk. So Iran is pulping, in terms of their economic obligations, financial obligations. They need higher price oil. But ironically, is if we reach an agreement with Iran, or if the world does, then that will serve to ramp up and increase the output of oil worldwide. So this is the final slide, folks, and then I know I have some time for questions. This is the U.S. dollar, and so you can see we have this long term since the end of last year through basically the end, right around now, a long-term consolidation, a long-term kind of stretched out triangular type structure, and then we've recently, just in the last week or two, broken out of that. I am very bullish the dollar for a number of factors, one of which I think to some extent U.S. The weakening dollar, weakening from, say, this top here or from this top here, all this little pullback here, and I speak of weakening dollar in a relative sense. Look at this is the longer term from last summer. We can see nothing but strength. Shorter term here, little pullbacks. That's a weakening dollar. Is to some extent, as I mentioned earlier, assisted in the U.S. exports internationally. But I think that again. The dollar of recent, we have a little triangular type structure, and inside yesterday's action relative to the previous day, this correlates strongly, about 70% with continuation of what preceded it. So that's all of these things spell higher U.S. dollar values intrinsically. This is a buy signal on a technical indicator. The reason that's important and why I included it in this webinar on oil is rising dollar in general will tend to push commodities and specifically oil prices lower. And so we've got an intermarket correlation, we've got supply-demand factors, we have the technicals, we have the wave, we have a couple of different wave descriptions or counts that are all consistent, and then we've got our timing in particular, if we want to consider that a separate entity. This week in particular, June 1st through June 5th would be the specific window, and what is of particular interest this go around is the idea that this window correlates with the meeting of OPEC at the end of the week, and thus far for the last few months they have been clearly indicating that they plan on maintaining the current levels of production and not budging in terms of a cut. If anything, there may increase production. And all of these things in the net suggest to me more probably further declines in energy. So again, in a practical front, we established a short position earlier last week. If one is not short, I think this will be a move that the run time, again, remember the previous slide, my next time target after this coming week is not until the middle of July. So what does that suggest? That talks about, on the order of 6 weeks, a month and a half of prices after we reach, say, the end of, the 5 to 6 weeks, let's say, for which I would expect declining prices to ensue. Beyond that, I have not yet projected, but we'll take it at that point in that, that month and a half or 2-month window of time. So, are there any questions, folks? This is the final slide, but I just wanted to highlight, just by another tenet of technical analysis, the longer a market stays in a period of consolidation, once it breaks, the more powerful and sustainable that break will be. One may not have, who is it, Larry Williams and various market researchers have over the years figured out ways to project when a market's in a channel like that, which direction, by looking at changes in open interest. If open interest increases, you can project the market's going to break to the downside. If you have a decrease, it breaks to the upside. In either case here, this is a fait accompli. The market's already broken, and we've got a little triangular pattern, and I expect further appreciation in the U.S. dollar. I believe that the country's stock perceives dollar strength ahead for some months to come. At some point, the dollar will top out. On a related front, when is the Fed going to hike interest rates? I believe it's not going to be until first quarter of next year, 2016. At which point, then I think the dollar will also interpret that as a strong point for different reasons. The other component, one other fundamental event of taking on more prominence and will be day by day, week by week, of greater and greater import to the world, is the situation in Greece and their relationship with the with the European Union and their willingness to reconcile and work out a deal with the IMF and the European Central Bank parties of negotiators. And that has to be done by, the time window for that is the end of June, I believe. They're hoping to reach an agreement. I think they're willing to pull off to some extent on their austerity. The new political party over there ran on a moving away from the austerity plan. I think they're realizing they have to, in the real world, begin to flex and be willing to negotiate. But that's another factor, and that will indirectly affect the euro, which in turn indirectly would affect the dollar and oil indirectly as well. Any questions, folks? We have a little time here. If there are any questions, I'm happy to address them as we speak. No questions. All right. Well, let's see the final slide. We have a webinar special, 1-month mentorship. I guess you can fill out the survey when I turn off the program, when I leave the presentation, and if you fill that out with your email address and/or phone number, whatever you're comfortable with, if you win the raffle, and we offer this, I guess, every month. Oh, thanks so much, guys, Frank or FRA, whoever. If you have questions, again, Frank Cameron and/or Peter Newman. Again, Peter is out of town in the next few days, I think, so Frank may be the person. If you contact Pacific Trading Academy, you would ask for him if you want to know in more detail. I've been trading for 35 years, I guess, now, and I've been teaching with PTA and coaching and mentoring with them for between 14 and 15 years. And so if you want to get more details about the curriculum and my specific procedures and in terms of teaching and instruction and topics that I cover, et cetera, talk to either Frank Cameron and/or Peter Newman, or if either one of those individuals contacts you, that you will know what that's related to. It's related to today's webinar or anything that we do in general in a broader sense at PTA or Pacific Trading Academy. And we have recorded today's presentation again, so if you've missed any portion of it or if you'd like to review, you can access, call us at PTA at the number, at the contact information, or access the website. I believe there are codes that you need to get the archived webinars that myself and my coworkers have done. This one in particular, as well as we've been doing webinars now. I've been doing them for the last 2.5 to 3 years, I guess, which is, I find it enjoyable and always look forward to presenting the latest, bits and pieces of information concerning different situations that I'm anticipating, and there's always opportunities for profit as well. And then again, on the instructional front, again, the format of a webinar such as this doesn't lend itself perfectly for instruction. It's more or less meant to provide theoretical carrots, if you will, that kind of present a big picture. And then if you want more detail, that's the format of teaching, and the varying programs we have is designed for more specifically to accomplish those in a precise way. So again, let's see, no more questions, I guess, or no questions. I appreciate your appreciation, and I know I'm speaking Monday as a panel discussion, and some of you may have received an invitation to that. That will be on varying topics other than oil, but specifically I thought it would be very good. Oh, let's see, there's another question. At last month, I think April 29th, I did forecast $60 oil, then 63, 60. Yeah, that is correct. So if you, whoever's asking that, let me go back just on that question. Let me show you if we see that. Let me show you, I presented that. I kind of mentioned that or alluded to that, implied it, one of these slides. Let me show you why and how, if we can find that slide. Yeah, target hit. I want to show you we are at $60. We settled at 60.30 yesterday, basis the July contract. Let me show you to whoever's inquiring about that. Some of this is Fibonacci. I do Fibonacci, and I present it here again. I don't want to typically depend on any sole model or relationship or indication. I use a confluence of different things. I use Fibonacci, I use gaps, I use, there's some certain numerical square root functions. I use something called the flower of life, is a price or it's a pattern that applied to price. I use certain harmonics based on musical scales, curiously, that certain Connie Brown taught me years ago. So when you get different, or when you utilize different forms of analysis, recognizing that no one certain one will be perfectly precise or sensitive to how a market's moving at any given point in time, but when you see when different ideas or models or approaches happen in spite of their differences to give you a similar output or the same output, it gives you a corresponding greater degree of confidence in the agreed upon output being at least in the correct ballpark of what you're trying to, the new information you're trying to grasp and further, get understanding on or clarified about. So you can see, let's see, this is, if this currently I'm projecting, if this is a bull scenario, again, this would augur for much higher prices. $82. This is the 1.618. I don't know if you can see that. Assuming that everything from, say, Thursday's bottom marks the end of a correction wave 2 of a new bull market, that would be quite bullish. Now, I can't rule that out. No rules are broken, but I don't see that as happening. Again, given the abundance of alternative type of information. Now, why can't, what's a plausible, what types of events could occur that might cause that to occur? Well, we have a further delayance of allowing Iran back in the market to export their oil to the world. We don't reach an agreement. We have an outbreak of war. They, in response, get testy and start rattling sabers, and there are tensions growing in the Mideast. That could certainly be a contagion or a factor that could serve as a catalyst or a trigger to cause a spike in energy prices, oil in particular, especially in that region of the world. So that would be a fundamental front that would be supportive of this bullish technical view. And we could see $80 oil in that case. Again, or we could see a surprise pronouncement out of OPEC next week. I just don't see that in the cards. But I can't rule it out. I wouldn't bet everything against on the bearish view and not leave and be completely turn my back on a possibility of factors which together, in collusion could bid the price up. I just don't. That's not where my money's going right now. But that's a scenario for the bullish count. We could see $80 oil. We got consolidation over there back where, it's possible resistance in the just above between $80 and $82 oil for the longer term. I just don't see that scenario playing out as being the most plausible one currently. This is, if this is a C, if we're still in a C, depending on the type, we could, if it's a zigzag, we could get up, that could be consistent with that $82 oil program and still be in a bear market, you see. Or if it's kind of a flat type structure, we could stay and zone out right in here. You can see where we got in that range that previously that you alluded to, we projected some time ago in a previous presentation. Yeah. So yeah, to your point, hopefully, yeah, we hit the target. So that's what we look to do. And whenever you see price and or time points that your analysis has projected, and you see the market consistent and moving into those levels at price and time, and at price and points and time, that adds confirmation in your thinking that you should maintain the procedurally the type of analyses and tests and models that you're applying. So it gives you a little confidence that you're on the right track. Okay. The feedback, I guess. All right. Fast forward to just so you have our contact page here. Yeah, so again, folks, it's been great. And if you fill out whatever your information is, and then you can qualify. And I'm happy, I don't get, by the way, I don't get paid if we have a special, if someone wins a mentorship, they get to work with me or one of my coworkers one-on-one, whoever you'd like to work with. If not myself, we have other mentors. But if you fill that out, and if you want to know details in specific, again, Peter Newman and or Frank Cameron are the people that you would address on that. Until that time, folks, let me just check one more time, see any questions. No, I think that's it. Again, I'm speaking on related topics on Monday, but the next webinar we have yet to plan, so stay tuned. All of you who are on our mailing list will get invitations, and I'll figure out a topic that I think is most germane and relevant in the next few weeks probably, and look forward to talking to you again. Until that time, I wish you a great day, great week, and profitable trading in the days and weeks to come. Have a great day. Bye-bye.